Hello, everybody. This is John Blank, Zacks Chief Equity Strategist, and we're going to go through today the top computer and technology ETFs. Um, this is our analysis, and it's going to basically give you the final third section of our discovery into computer and technology stocks by just talking at the top line about the ETFs. But this is a great way to study the valuations of the overall market, types of special ETFs that are particularly available in this market when they came available to you, and of course, underneath the hood, the top 10 stocks in these ETFs and how they are doing. So, this is very critical information for finishing up our study of the computer and technology industry. Of course, our disclosures are always necessary. This is just my views, John Blank with a PhD, of course, and not the views of Zacks Investment Research. So let's get going. The first thing we want to talk about today is the top computer and tech ETFs. And we're just going to have to go through a couple tables of all the information about these ETFs. As I circled up in green here, there are lots of specialty ETFs considered. So what we've got here is assets under management right here. And of course, the biggest one is the Qs with 17 billion. Then the Vanguard Information Tech ETF at 45 billion. And then Technology Select Sector Spider ETF at 42 billion. Of course, iShares will be in fourth. So there's four big players up here in the broad technology space. And those go back to the 99, 2004 era. So this is the true technology ETFs that originated 23 years ago. And you can see they follow different benchmarks. Keep this in mind that you want to make sure you study these benchmarks as well as the expense ratios and the inception dates to really understand that by and large, the ones that are 23-year-olds are cheaper from an expense ratios perspective, give you broader coverage, and have been around for a much longer time. So that's really, the bulk of the investing will be done by these names that you should know and know. Of course, the Qs are often talked to by name. VGT, XLK, and IYW will be tickers that we will use and see throughout this slideshow. So, by the way, keep in mind this is our summary slide. I just want to point out also that ARK is in here at 6.5 billion now with a 75 basis point expense ratio. It started in 2014. In many ways, the ARK ETFs were kind of the beginning of this latest surge in specialty ETFs. As you can see, we have China ETF, we have expanded tech software, we have NASDAQ cybersecurity, we have exponential technologies, equal weight technology, cloud computing, global robotics and automation, and again, cybersecurity. And of course, down here, once again, the next generation internet from ARK, again, very expensive. So Cathie Wood gets out in 2014 with very expensive ETFs. And of course, she's doing this because it's kind of an active platform. You can see there is no benchmark index for her funds. All the other ones that start off in various times around here, 2015, 2011, and 2013, have actual indexes that they track. That's something to keep in mind. Of course, that keeps the price down. She says, well, I picked them and it's better for you. We'll get into that later in the slide deck. But this is the basic component structure. I just want to point out that, you had for basically 15 years, very limited opportunities at the broad technology area. And it only began in the last cycle to have become specialized. And you're going to see in this slide versus the next slide, they're going to come in waves, and the larger asset under management ones go back further in time. This is always the case. The longer a fund stays around, the more it builds assets. So keep in mind, once again, the big points, you can stay at the broad level fairly cheaply with 3 or 4 different index providers. You can get into Cathie Wood's funds, which are actually some of the most expensive outside of the directional ones, the Bear Bull 3Xs. And then we have a lot of different specialty ones at various price points and at various times of entry. So this is interesting to keep in mind. This is our summary table. We can come back to it as we go through this. Table 2, of course, is the smaller ones. We're going from $1 billion under management to 200 million. And again, we have a lot of different fancier specialty type plays. Next generation connectivity, cloud computing, cybersecurity, transformational data sharing, mobile payments, the metaverse, innovate equity from Goldman, Internet of Things, small cap infotech, software and services. I just want to point out for this set, you can see 2019, 2019, 2021, and 2020. A lot of these smaller ones are not smaller because they're less valuable. Some of them are actually cheaper to buy. They're just newer, and it started in this last wave. So you have to think about it and say, okay, there may have been three waves. One from 2000, another one that starts somewhere with the ARC funds in 2013, and then a final one here just before the start of the COVID pandemic or during the COVID pandemic that picked up yet some other names. So obviously, metaverse now it's 2021. That's even the newest idea. So keep this in mind. We've got a lot of people trying to sell you these plays, applications, and we have yet to see later. We will see if this has bought you anything at all. All right, so first level, let's do the top industry segments. Up here, those are the segments I'm talking about that we've been naming. And down here is the issuers, the issuers. So again, you're going to see here that Vanguard, Invesco, and State Street and BlackRock are really big. Van Eck is much lower down here. Those four are really going to drive the bulk of the action. And of course, the Invesco Qs are 173 billion in this. So immense plays are just kept on the Qs. Over here, we're seeing percentage change in the last 6 months or so. And you can see for the most part, people have been taking money out of these funds. I think that's interesting to note that there has been such a negative profit taking, I guess you would call it, in this area. People are just taking funds out. They're putting funds somewhere else and they're taking profits because they did run up really nicely in the last few months. So over here, you've got all these different types of plays. So obviously the most important semiconductor industry ETF will be at 25 billion. That's going to be the next level specialty below broad technology. It's only 10% versus that 300 billion. It's 25 billion, less than 10%. Then internet software, internet architecture, cloud computing, social media, networking, cybersecurity, and down here at the bottom, of course, with almost no investment is nanotechnology. So again, this is basically the story here is the semiconductors have come a long ways in terms of being set aside and you can play them. That's very distinct. And then beneath that is a lot of stuff that has uncertain promise and a lot cloudier stories with them. So let's continue. All right, weekly change. Again, this is just running over the last few weeks. We can go over here and see that by and large, it started out in even during the early March period, people were buying these things, but they haven't been lately. And that's to keep in mind. Again, here is incredible list of ETF providers at very low billion or less. There are an immense number of providers here. This is effectively, if you go back here, this was down to 2 billion. Now we pick up here and we find all our way down to these super tiny ones that have basically no assets under management. I wouldn't stop right about here. 250 million under management is probably as far below that. I wouldn't even bother with these groups here. But you can see there's an immense amount of innovation going on within the structure, and people are really trying to break in, but it's really held in a kind of an oligopoly framework with those big four players. So let's talk about assets under management. I just want to point out that when we're studying this with the prices that exist within these assets under management, this is basically showing you the valuations of the market for infotech. And they're very you can obviously see we ran up into that October 21 high here in this computer and tech ETFs, and it basically faded, other than IYW, which, as we pointed out earlier, is one of these areas. I think it's iShares status. The iShares one actually outperformed on the way through this cycle. By and large, though, you can see that these ETFs have been somewhat stagnant from that period of a high in 2021. There's really a very consistent story here, other than once again IYW being the outlier in terms of picking up assets under management. Worth studying IYW a little more extensively to understand why it has done slightly better than these others. But you can see some of them have them, for example, ARKW, good old Kathy Wood. She is at the bottom here. SOX, SOXX, that's your semiconductor one, and it has started to also pick up of late since October when the turn in the inflation came about. There is some evidence, particularly in the semiconductor space, that there was a pickup here. Keep that in mind. Here we have SOX down here, also doing a nice pickup along with IYW. So keep in mind this. We have a good study of this, how the market is playing out. We'll continue this with the price performance. So again, here I have right up here in that aqua line is SOX. That's your semiconductor ETF. It is that aqua line, and you can see that for by and large, that was the trade to make, and it probably remains the trade to make. It did sell off big for 21 to early 2022, but it's back on its longer term trend. By and large, did anything turn out better or worse? Here is my IYW. We talked about this earlier as being one of the better ones. Do we see that playing out here? The answer is somewhat. It's at the top of the level. It's not at the bottom of the level, but it's at the top of the level. Over here, I put this red arrow with RKK. Of course, this is Kathy Wood's Innovation Funds. Take a look at it. It did outperform into the highs at the COVID pandemic and has underperformed ever since. So in general, she, has not given you a very stable ETF structure. If you're looking for something that was stable, you can see IGV. Probably again, that was the play. These iShares ones with an I are actually looking like fairly good trades. Here's IGM, which also did fairly well. So anything with an I will be, of course, iShares. And you can see the I's actually do somewhat better. So keep that in mind that you may well want to look at the iShares types ETFs. They are holding up a little better. XSD and all these other ones, I believe these are some of those more expansive plays that have different leverage. And then, of course, the robo stock one, which is kind of like a mini Kathy Wood thing. As you can see, it wasn't so bad. It didn't go up as high and didn't go down as low. And here's, of course, the CQQQs. Those are they're super leveraged ones, and those always end up doing really poorly. So all in all, I can tell you that I would basically take a look at these I funds. They are IXN, IGM, IYW. Those are the ones that have seemed to held up a little better. All right, equity betas. Obviously, you trace the market beta. That'll be 1 here in all these slides. That'll be the stock market, the S&P 500. And as you can see, in general, if you're looking for equity beta, you're looking to outperform the market by 10, 20, 30%. These types of stocks do, and these types of portfolios do better. So if you do get a bull market, just keep in mind the broad message here, which is equity betas, usually over 1. And they do move up and down. Let's just take a look at the SOX, which we all know is the semiconductor big ETF. It can go up to as high as a 1.4 or 1.5 beta, and then it went way, way, way down to a 1.1 beta. Now it's back as a trade that's outperforming the market. So this is interesting. You can see that one of the things you can do here in terms of timing this is to buy the equity betas at their lows and sell them out at their highs, the actual equity beta itself. Fascinating story here. Again, you can look through all of this stuff. IXN is those I things. There's IGV. And of course, down here is IGM. And you can see IGM really did get a big trade here and get accelerating into higher beta stuff. That's telling you that people are putting relatively more money and it's getting relatively more performance of late. Okay, so let's keep going. Price to earnings charts, of course, valuation always matters. And of course, we see that everything ran up into that big bubble in 2021, and then it sold off until it turned when the inflation numbers started to come down. So we went all the way up from 2019 to 2021. It was a nice 2-year run. We went down for a nice long year, at least into the October lows of last year. Now we're coming back. Worth keeping that in mind. You see this again, IGV, which we've talked about as the iShares ones, actually has a much higher price earnings ratio. And over here, we've got VGT, which is the Vanguard one, very large one. It's sort of now at the higher end of things. So what we also see here is ROBO. That, like we said, is that special robotics and automation, kind of the Kathy Wood thing. And you can see it really spiked up and it really fell down. So keep this in mind. We have lots of stories here. If you want the broadest story, of course, that's the Qs. That's right here. And you can see it is right in the middle of this story. So is there a specialty trade that did better than other trades? I think the answer is no, because these only get you much higher beta and much more performance in really bullish scenarios. Otherwise, you're better off with these broader ETFs over time. Okay, price to book value, little different. Structuring of the valuations, and you can see this big cliff coming off the book values back down into the sixes over here for this group. That, of course, is that big sell-off, and now, of course, it has stabilized. So right now, just from a technical perspective, you can see all these charts for the last 7 or 8 months are giving you better book values, and they're actually trending upwards. So that tells you that people are more receptive to these ETFs now than they were before. That's going to wrap it up for our study at the broadest ETF level. I'm going to go through a little last talk about the big major stocks. Okay, so here we have the ETF ticker. Of course, this is the Qs. There's the Vanguard funds. There's the XLK, that'll be your spider funds. And of course, the iShares over here. And then the Zacks, the semiconductors. Those will be the big 10 names. So obviously, folks, the easiest way to save on expense ratios is just to buy these stocks. So you can see there's a lot of overlap here in these big major ETFs. Of course, there are. You can also see, for example, Vanguard has Visa and MasterCard, Accenture in here in their ETF. They do think of those as infotech companies. Over here, you have PepsiCo, Amazon. Over here, you've got more pure play, I would say, infotech. But again, there is Accenture. And this is always the case, other than, of course, over here, that these are actually all chip stocks. But if you're looking for a good chip stock name, of course, you can just go over here and play one of the top 10 here. This will be another one of these semiconductor SMH is another one. Of course, here is Kathy Wood's names, and you can see these are quite different. Quite different. Over here, these are the Chinese names. So again, if you just want to learn what the big Chinese tech names here, come over here and look into all this. Trip, Baidu, JD, Tencent, Alibaba, Meituan, NetEase, PDD Holdings, KE Holdings. Easy way to learn more about the Chinese big cap tech names by just studying KWeb. So there we have it. Lots of information and names of companies. Here, down here, again, nice set of names in a smaller ETF ticker, IGV, which we talked about a lot. And you can see things like Palo Alto Networks, Intuit, Cadence Design Systems, good names here. So that may be the reason IGV has done so well. It actually does have different and perhaps better selected names. So that's going to drive a lot of performance here, folks, if you have better chosen names that are more relevant versus names that are not. So always look under the hood here. Always study these charts and also cherry pick the names if you just want to buy stocks. You're getting a lot of asset class research and stock selective research just by looking into the top 10 AUM holdings in these ETFs. All right, price consensus and surprise charts, of course, in Zacks, this is always of interest. So I want to point out that for the most part, for example, Logitech doing very poorly in their estimate revisions of late. AMD, not great. WDC, not great. Only ASML and TXN, the very big chip names, are holding up and stabilizing. Of course, they are driving the interest that there is a turn in the cycle in the semiconductors. But if you're not in the semiconductors, for example, Logitech, or you're in the wrong part of them, WDC, we're seeing some very significant downward revisions. So keep this in mind at the estimate revision level, broadly speaking. You got this, run into the market, and then you have the market actually trading rationally down on estimate revisions pretty much across the board where it sees them. So the market has been rational about the underlying estimates of most of the major stocks in these ETFs. All right, the Zacks ranking of these different things. This goes back from 2016 to 2022, last 6 years or so. And you can see we generally like this area. It's a 1 or 2 most of the time for most of these areas, most of these stocks. But keep that in mind. We do generally outperform because of the higher beta nature of these stocks, and we generally have very strong sentiment across investors, particularly institutional investors who just like these types of plays. So that's it for me. I hope you enjoyed it, and thank you for attending. You're certainly welcome to get all of this information from us, and that's exactly what we do these presentations for. Here's how you can do that. Okay, so number one, you can call us 866-794-6065. You can email us at strategycall@zackspro.com, or you can find us on the web at www.zackspro.com. All these three things are obviously very available to you, and you can go ahead and use them. Also, on LinkedIn, we have a Zacks Professional Services place, and when on Twitter, you can find us at ZA Tools. So once again, the easiest way to get a hold of things from us is to call us 866-794-6065, or to send us an email, strategycall@zackspro.com. Thanks a bunch for coming and hearing a lot about our third and final discussion of computer technologies. This time it was the ETFs. Thanks again.